You made it to retirement. Now you're trying to figure out, all right, where do we start pulling money from? How do we pay Uncle Sam as little as possible? Let's talk about that. Let's talk through tax-efficient withdrawal strategies in retirement years. So we'll go through a little bit of just a breakdown of some of the accounts that we'll be talking about, how taxes affect your retirement, and then we'll talk about a little bit of strategy here to help you out to make sure we go through that. So the breakdown of the accounts. What have you got? What are these accounts? How are they going to be taxed? Well, you may have an HSA account, and if you have one, great job. I'm not going to touch on this as much after this, but just talking through the basics here to make sure you're understanding your HSA. So you can use this for healthcare expenses right this second, qualifying healthcare expenses. But if you are 65 or once you reach age 65, you can actually use it for Medicare Part B and Part D, and then the Medicare Advantage Plan premiums as well. So that's a little sweet bonus for you to be able to spend that for that. You can also go back and let's just say that you had a lot of expenses that you didn't use your HSA for. You can actually reimburse yourself. Now, that's a bonus that you could add in. I could make a whole video on that. I think I have actually before, but that's going to be for a different day. But then we got the pre-tax accounts, your 401ks, your IRAs, simple IRAs, SEP accounts that you will owe ordinary income tax on when you are retired. Then you have your Roth accounts, your Roth 401k or your Roth IRA that are tax-free. You've already put money in and paid the taxes on it, and it grows tax-free as long as you've met the 5-year rule. So just make sure that you've had your Roth IRA open for at least 5 years when you're retired and trying to withdraw from that, especially if you're over 59 and a half, you're good to go. Taxable brokerage accounts, joint brokerage accounts, individual accounts, they're kind of all called the same thing. Everybody uses different terms for those, but they're subject to short or long-term capital gains on growth, as well as on dividends and interest. You have to know that you'll have to pay some taxes on that. Oftentimes the dividends are, as they're qualified, it's going to be either 0 or 15%. I'll show you a little bit of that too, but we can talk through those. So those are just kind of the breakdown of the accounts. But, we've really got to figure out, all right, well, where are we standing here? Well, in 2024, here's some brackets for 2024 to give you a breakdown, because if you are wanting to really play the game here, you've got to know the tax brackets. And so if we're looking right here, you can see these. I won't go through every single one of them, but you need to understand, are you a single filer or are you married filing jointly? That's oftentimes the two. If you are filing separately, married filing separately, it's going to be a little bit different, but just make sure that you're cautious about this and you're focusing on what your tax brackets are. Now, something, if you didn't catch, we did a video on Friday and we talked a bit about too on strategies on reducing your taxes. And it was all along the lines of capital gains, and then also qualified dividends. So if you're looking at this chart here, this is a way you can actually pay 0% on your taxes. Now, you have to think through, where's your income coming from? You're going to have Social Security. You're going to have pensions. So your Social Security is a little bit different of a tax, the way that one works. Pensions are often ordinary income tax. But so if you're looking here at this breakdown, you could potentially have long-term capital gains that are going to come in as with this chart. And if they are under a certain threshold, and it looks like 47,000 for unmarried individuals, and if it is under 94,000 for married individuals, then you have the ability to not have to pay long-term capital gains or even taxes on qualified dividends. So that's a huge bonus in itself to play the game. You sit there and you watch these people such as, let's say Warren Buffett, and you hear, wow, Warren Buffett only paid 20% in tax this year. How did he only pay that? And this guy's worth billions of dollars. Well, it's all on the long-term capital gains. And if you look here, if he had over a certain income, as long as it's a long-term capital gain, the max bracket there is 20%. So he's not going to be paying some excessive amount. And people, I'll leave that argument for everybody else and what their thoughts are. And so what are some ways we could do this here? Well, we've got to focus on the 3 T's. And so that's taxable, tax-deferred, and tax-free. Those are the ones that I talked with you about. Like I say, you have the HSA that was the bonus in there, but these are the 3 main accounts you're looking at. Your taxable account, such as the brokerage, the joint account, your tax-deferred account, your pre-tax account, 401k, traditional IRA, rollover IRA, or your tax-free, which would be your Roth accounts. So that's what you really want to think through. And we've just got to really figure out, okay, what's the opportunity here? Well, number one, just what I go back to what I was talking about a minute ago, and that's knowing your tax bracket. Because in the retirement years, you have to know, hey, if I pull from this account first, what is that going to put me in? What tax bracket? How much money am I going to pay? Because if you have a nice mix of a little bit of taxable money and tax-free and tax deferred, you've got a nice mix there. You can play the game a bit with this. Now, oftentimes we find that the best breakdown is a taxable or brokerage account you spend down first, then tax-deferred money, then tax-free. But that's not everybody's scenario. That's just kind of the baseline that we like to see people working through. So if you're figuring this out for yourself, if you're spending down those taxable accounts, you have the ability to do Roth conversions. On those Roth conversions, you can take pre-tax money and you can actually convert that over to Roth or after-tax dollars and let it continue to grow. Now, you could also look at spending down some of the IRA, because we do have to remember in the retirement years, your pre-tax accounts, whether you want to spend them or not, the government's going to eventually find you and say, hey, guess what? There's something called an RMD, or required minimum distribution. You have to start taking money out of these, and you've got to figure out, what's that going to be? They're going to give you a set number, and it's based on your longevity or on mortality tables, and they're going to start to make you take that money out. So make sure you're figuring that in as well. And then finally, really just leaving the Roth for the last withdrawal. That is the best scenario for you, because you're going to allow your money to grow tax-free and continue to compound and grow. Now, one thing that I do see with people though, and when I tell people that, I say, well, there is always the what if. And the what if is, in your scenario, is maybe you're going to buy something and you say, hey, you know what? I'm going to buy a car this year. And let's go back for just a second, back up to our tax brackets. And let's say you're retired and you fall in the 12% bracket. You're $23,000 to $94,000 in income, and you're married filing jointly. So that's the bracket that you're in. Let's just say that you're at $94,000, but this year you're going to go buy a car and you're going to spend $30,000 on that car. Well, that's going to bump you up into a 22% bracket. And on that $30,000, you're going to pay 22% in tax when you have to withdraw that, if you did that from a pre-tax account. So we have to look at the game here and say, well, what if we took a little bit of this Roth money and we actually had the ability to use that Roth so that we avoid the 22% bracket altogether? Now, there's a lot of math that comes in here and a lot of financial planning to make sure that that's the best scenario for you. But that's just a little bit of a nugget, and that's the kind of stuff we do here at Jazz when we're doing the planning with clients.